Hello, welcome to today's exciting episode of the Law Show. So glad to be here. Missed you all, and I hope it's been a wonderful life. Now, today I want us to look at how to recover life insurance benefits of dead relatives. Life insurance benefits of dead relations. How do you recover life insurance benefits of dead relations? Now, what do I mean by life insurance benefits of dead relations? That seems to be a mouthful, but I will explain it. You know, usually when people, particularly in Nigeria, die, you have the relations, the children, the wife, the relations usually crying, "Oh, government, help us. Our breadwinner is dead." Because that person, when he was alive, used to bring home monthly income to sustain the family. And now suddenly the person dies, and they feel that they are actually lost. They are hopeless. There's no money coming in again. There's no way for money to come in. And, so usually you find them, crying to government, help us, or looking to private individuals, or even looking to relations, for help, because they think that, there's no help, no succor, no finance somewhere. They think that the person who died perhaps didn't have a fat savings account or some money set aside in the bank or some property that they can monetize and use, for their upkeep. Maybe students are in school. How do they pay school fees and all that? So this is where the law makes provision. The law made a provision for dependents of dead workers. The dependents meaning those who survive a dead worker. You're working someplace, and then God forbid, the person dies. The dependents will not be comfortless. They will not be penniless. They will not be, all right, we don't use penny in Nigeria anymore. They will not be naira-less or kobo-less in Nigeria, okay, or dollar-less if you're in America. So that's what I want us to look at today. How to recover life insurance benefits of dead relations. Now, why do I use the word recover? How to recover it? I mean, is it something to be recovered? Is it not something that should just come naturally? I mean, if it's your father who was working, for example, in the army, the navy, or working for a company, and the man suddenly dies, do you have to recover the insurance benefits? Shouldn't they just pay it to you? Okay. Well, the answer to that is a capital no. From experience, I found out that, and I'm sorry to say this, I'm a little bit sad, but this is the reality of the Nigerian scenario. Most employers of labor, most companies, most establishments don't readily, as a matter of course, pay out insurance benefits that are due to the dependents of their ex-employees or their deceased employees. They don't do it naturally. They don't do it readily. They always need to be forced to do it. They always need to be forced to do it. Somebody may ask, why? Well, the reason is because we're talking about a lot of money running to millions of naira. And oftentimes, I have discovered that they just take the money, okay? They just take the money. I mean, the person is dead. The relations don't know that he's entitled to some money. They ask the insurance company for the money, and I'm going to talk about that a little bit more in this video. The company officials will ask the insurance company for the money. The insurance company will give them the money, the lump sum payment. Then they will give a pittance. They will give a pittance to the widow or the family, put it in an envelope and say, we have come to pay our respect. This is what we have for you people. They buy a casket or buy this or buy that. And then the widow and the children are thankful. Thank you very much, sir. Thank you. We are grateful to you for what you have given us. And they forget about it. When these company people get back to their company, Don't forget, they've received the money already from the insurance company. What do you think they are going to do with it? You know, Christmas has come early. They share it among themselves. So I'm not making it up. I've had one or two experiences in this, not personally but professionally. You know, I remember a matter where someone was working with the bank and she had died, and the bank didn't employ her directly. If you know how banks in Nigeria crookedly, sorry to say, employ people, they don't employ directly these days. They employ through shell companies, which are actually just companies existing on paper. So this company are the ones that employ people for banks. So they employ you and like second you to work in the bank. So you are working in the bank, but you are not a staff of the bank. You are a staff of that company. So if anything happens to you, the bank will say, well, it's not our staff, it's the staff of that company. I don't want to mention names, but if you are watching this, you work in the bank, you are somebody that works in the banks, you know what I'm talking about. So let's say Bank Pinnacle, Pinnacle Bank, for example, wants to employ. He won't employ you directly. He will employ you through IJC Limited. So IJC Limited is your employer, and IJC will second you to Pinnacle Bank. So if anything happens to you, Pinnacle Bank will say, well, you're not, you know, it's IJC Limited. So IJC Limited will contact the insurance company. Our employee has died. IJC Limited collects the money, puts some in an envelope, and gives to the relatives of the deceased. So now, what I did was, I had a real fight, both on the phone and in letters. And I wrote to the insurance company. First of all, I had to speak extensively to that company that employed that deceased person before they reluctantly disclosed the name of the insurance company. Reluctantly. After a lot of fight and quarrel and threats and I'm going to sue you, I'm going to do this, I'm going to do that, before they, okay, all right, this is the name of the insurance company, but we have paid. So I had to do a letter to the insurance company and copy the bank, and copy everybody, copyables, president of the Senate, governor of every state in Nigeria, blah, blah, blah. Until suddenly, the beneficiaries who that company had already paid like 230,000 or 250,000 naira, and they had said, thank you, bye-bye. Suddenly, they got about 4 million naira into their account, you know, as the insurance benefit. When questions were now raised. So it happened once, it's happened twice. This is why we decided, let's do a video on this so that people will realize that you're right. So realize you're right. Okay, so let's start with this. I don't know if we are starting or we've already started. I hope we have done some introduction. The first thing I want you to know, and this is the basis of our conversation, is that every employer of labor where there are more than, used to be 5, between 3 and 5 full-time employees, has a statutory obligation to take out a group life insurance policy for all the staff. So it's a statutory obligation. I'm going to read it out for you, so that you'll see. This is the Pension Reform Act of 2014. Pension Reform Act of 2014, Section 4, subsection 5. Okay. I just skip to the relevant portion. It says, every employer shall maintain a group life insurance policy in favor of each employee for a minimum of 3 times the annual total emolument of the employee. So every employer shall maintain a group life insurance policy in favor of each employee for a minimum, this is the minimum bar, of 3 times the annual total emolument of the employee. So if an employee dies, his benefit, his life insurance benefit will be 3 times his annual emolument. So you look at the annual emolument and multiply it by 3. What's an annual emolument? Annual emolument is your salary. If you have a leave, what do you call it? Leave bonus. In fact, everything you get from your employer for the whole year is your emolument times 3. It's what the person will be, the beneficiaries will be entitled to. Okay. Now, where however the employer fails, refuses, or omits to make payment of premium as and when due, the employer shall make arrangement to effect the payment of claims arising from the death of any staff in his employment during such period. So, it's really up to the employer. You have an obligation, statutory obligation, to ensure the life of all your staff. But if you don't do that and a staff dies, so the law expects you to calculate his annual emolument multiplied by 3 and pay it to his dependents. So it's up to you. You want to take out the insurance and pay the premium, which will be much cheaper for you, or you want to do it if you lose an employee, so you have to pay out that lump sum to the beneficiaries. Okay? So now you need to understand this. This is a statutory obligation. When I mean by statutory obligation, I mean that it is compulsory. The law has made it compulsory. It is not optional for the employer to decide whether, if an employee dies, he will pay that amount. It is not optional. He must pay it. It's only whether he will pay it directly or he will pay it through an insurance company. That is the one that the law gives him some leeway, because you can decide, okay, I don't want to take out the insurance, but if the person dies or any of my employees dies, I'll pay out directly to the beneficiaries. Okay? So please bear this in mind. It's not something you go and start begging, oh please, we've lost our breadwinner. What do we do? You just know what to do now. You get a smart lawyer who will request for that. Now, what is the procedure when an employee dies, when someone dies? How do you collect this money? How do you collect it? What is the procedure? Now, first, let me tell you what happens in practice. What employers do is that the employer will write to the insurance company and say, we've lost Mr. What's the name of this one? Mr. Bina. Let's call him Mr. Bina. We've lost our employee, Mr. Bina. The insurance company will say, okay, send us the death certificate, blah, blah, blah. They will call the family, please, let's have the death certificate so that we can process something for you people. So they will give them the death certificate and others. They will send it to the insurance company, who will now pay them the money, and they will now pay out to the beneficiaries. But that practice is not what the law provides for. That's not what the law provides for. I'm going to read to you what the law provides for. Section 8, subsection 1 of the same Pension Reform Act of 2014. I think there's been some amendment here of this law, but these sections are sacrosanct. These sections are not, they are untouchable, okay? So whether amendment or not, these sections remain. Section 8, 1. When an employee dies, his entitlements under the life insurance policy maintained under subsection 5 of section 4 of the Act, the one we read before, shall be paid by an underwriter to the named beneficiary in line with section 57 of the Insurance Act of 2003. I like that provision of the law. Where an employee dies, his entitlements under the life insurance policy maintained under this act shall be paid by an underwriter, insurance company, okay? But shall be paid by an underwriter to the named beneficiary. In other words, the insurance company shall pay to the named beneficiary. Not that the insurance company shall pay to the company where the disease worked, for that company to now pay to the beneficiary. No. The insurance company and the beneficiary will deal directly with each other. There should be no intermediary, no agent. The company where the man worked cannot be the agent between the family and the insurance company. And I found out from experience that most companies don't want to disclose the insurance company where they have this group life insurance scheme. They don't. You have to force them. You have to beat them up before they will give it to you. And you got to do it because, hey, I'm sorry, I know you've lost somebody, but there are millions at stake, millions of naira at stake. And you got to fight for it. Money is worth fighting for. That's what I believe. Particularly if it is money that your father or your mother or your brother or your sister worked for. You're not going to let someone else take it. Okay, you remember what Shakespeare said? So those of you who study Shakespeare said, men will soon forget the death of their fathers, but not the loss of their parsimony. Men will forget the mother, not the death, the mother of their fathers. That's the way Shakespeare put it. A little bit extreme. Men will soon forget the mother of their fathers, but not the loss of their parsimony. In other words, you kill a man's father, okay, after a while he will forget. But if you take his inheritance, he will never forget. That's what Shakespeare said. And if Shakespeare, who lived, so many years ago, can say that, who are we in this day and age? So that's the principle, that the insurance company is to deal directly with the beneficiaries. Now, I know when you are watching this, you have a lot of questions. You have a lot of questions you want to ask. And there's a comment section, I'm sure, where you can leave your questions and the producer will get back to you. Now, and I'm going to say this. If you leave questions, please leave a contact information that they can reach you on. Don't just think that everyone knows you. For goodness sake, you are not President Joe Biden of America. That is the only one everybody knows on earth. If you are not the president of the world, maybe everybody doesn't know you. And I'm not saying this in a sarcastic manner. I'm just saying that some people will ask questions and they will say, oh, I need help in this area and that area. And their name will be Yung Tang at whatever, something, and that's it. That's the contact detail, Yung Tang at. Who is going to find Yung Tang? Baby Presh. Baby Presh. Where do you send information to Baby Presh? So leave some contact information so that, somebody can reach you. Perhaps an email, something like that. Or an Instagram account, IG account, so someone can actually reach you, with some information. All right? So that's two things we've said here today. Don't forget it. Number one, every employer is statutorily obligated to maintain a group life insurance policy for employees, which the beneficiaries of a deceased employee can access. Okay? That's number one. And number two, the beneficiaries are to deal directly with the insurance company. Okay? Now, the only other thing we can talk about is how much is this calculated. There's a schedule for calculation at schedule 2 of this law. It's quite a long schedule. There's a way they compute it. How many years you have worked and what percentage of your gratuity as percentage of total final, pension as percentage of total final, etc., etc. So there's a lot, it's actuarially done, but it comes out usually into a couple of millions, usually if the person has worked for a while in that establishment. So it's worth your while to take a second look at it. If you have any questions, you know how to reach us. And if you have not subscribed to this channel, I wonder why. I mean, it's free. It doesn't cost you anything to subscribe. You already have a Google account. Once you have a Google Mail account, all you need to do is subscribe. And if you like the program, give us a thumbs up, click the like button, and I'll see you again. Bye-bye. 24 hours, 7 days a week. You can find your favorite program, Law and You, only on Pinnacle TV.